All right, everybody. Welcome here to the session. We're actually going to have here Mark Putrino, all right, former hedge fund manager, traded with Steve Cohen, Mario Gabelli, multi-billionaires, $35 billion plus 35 B with a B, okay? So Mark Putrino definitely has some really hardcore experience in Wall Street. He's been a market maker. He's done a lot of stuff there, so for 20 years. And more recently, lead trader, chief educator at the Benzinga Trading School, pretty much taking this whole task fully on board on his back from the beginning. And it's just been really great what Mark has been able to do there with everybody. So number one, shout out to all you guys for being here. Thanks for waiting. And I think we have Mark. We're going to get him here um, live here in 1 second. Hold up, guys. Let's give a shout out. Big shout out here to Mark Putrino. Let's see. All right. All right. I think he's in now. I think we're all good with Mark.
Hey, Rodrigo.
Hey, Mark. What's up, man? How are you?
Hey, good. How are you?
Good, man. Great class today. It was a good session, right? Really good to chop down the markets. It's always good to have that sort of fresh mind. With the class today, right? Because it's like at 7 a.m. the first class, the other one's at noon, but the morning class is always my favorite one. It's about 2 hours, right?
Yeah. Typically 2 hours. If there's a lot going on, we'll typically run past that. But yeah, the morning class is 2 hours, and then the noon class goes from noon to 1. So in the noon class, we just review a lot of the things that we covered in the morning to see how they're working out. Particular things when we might be looking at. Like for instance, this morning we were looking at how copper looked really weak and how the copper stocks looked weak, but now they're down so far that I think there's probably time to buy them. I think we're probably going to get a reversal. So I'll show you guys that when it's time. But yeah, so we cover a lot of things,
Right.
and what's going on in the market in the real time, as opposed to just having a book and like a backward looking thing. So it's a good time, and it's a good time. People are enjoying the class because there's a lot going on in the market, and this has been a really good market for traders. So most of the students are traders, although we have all different kinds of investment styles. Yeah, it's been a great market for traders, so things have gone very well.
Twitter space on the other side. Can you hear me there?
I can hear you. You're putting this on Twitter? So the way the class works is we start off talking about particular fundamentals in the market. Today, the class was on momentum, and then we look for things that are overbought and oversold, and that we can get kind of trading ideas from that. So the principle that we're covering is the concept of what is momentum and how can you use it. And then, like I said, instead of looking into the past to see examples where it worked out well, we look into the actual market in real time. So I think that makes us different than a lot of what other people are doing.
Right. No, that makes sense, Mark. And look, man, it really comes down to the fact that knowing how to read charts, even though a lot of people might overlook it, right? Oh, I got this. But they complicate themselves. And look, I understand there's a lot of misinformation out there, Mark. There's a lot of YouTubers, TikTokers, all that stuff. So I think it's really good that retail traders can actually learn from somebody that's a professional trader, right? Someone that's actually traded, with a heavy hand there. With people like Steve Cohen, I mean, these people are like legendary folks.
Oh yeah, we could be certainly one of the greatest traders of our age, if not of all time. And then Mario would be one of the greatest investors of all time. And so I was very privileged to to start my career working for those guys. And then from there, I went on to where I was the head of trader at 3 different institutional money managers, where I oversaw various traders, various trading strategies. So there's really not too much that I haven't seen. And when I decided to kind of come over and do this education thing, I did some research, surfing around the web or whatever, looking for other trading classes. And I was really just kind of taken aback with just how much garbage is out there. And it's everything from, people that think they know what they're doing and they're trying hard, but they just don't have the experience to really understand, to the other side, which is just downright fraud. People just lie. But people think that trading is like this really mysterious thing, or like hedge funds are really mysterious, or what's an algorithm, what are dark pools, so forth and so on. And it's really just not as complicated and as mysterious as people think. So in addition to trading, we also talk about the way the markets work, the way Wall Street actually really works. So we cover a lot of different aspects. And I think, Rodrigo, that's one of the things the students really like.
Right. And I mean, Mark, look, you have students there from pretty much all over the world, right? From all ages, from pretty much every corner that you can imagine, every type of person. And it's just, whenever everybody comes together, like the community is pretty great. Those guys love you. You have students there, and seeing the progress it's just really good, really good, because there's just it's just so easy to kind of get misguided in the markets nowadays with, people watching the news or things like that, like that sort of stuff.
Yeah, I mean, there's a lot of misinformation out there. And, I tell people, like, shut off CNBC, don't even bother listening to it, and all these other financial networks. Because the vast majority of the time when they're trying to explain what's going on in the market, they're wrong. They just attribute it to the headline of the day, the headline du jour. But in reality, the most trading in markets is really just, I guess you could call it noise, right? If a market's not moving more than 10, 20, or 30 basis points, it's just kind of random noise. And the media always tries to make it so like every little move is related to some kind of financial news. And that's just not how it works on Wall Street. Like, no one's sitting around watching CNBC waiting for trading ideas to come along, So that's one of my fun things. And I like explaining to people too what market makers do, because, when I was a market maker, I didn't realize that I was a bad guy. And for some reason, a lot of people think that market makers are out to rip people off, and that's just not how it works in the real world. So I could cover that too today if you think it makes sense, Rodrigo.
Yeah, I mean, I'd like to get your take overall in the markets right now with what's happening with inflation, and just the craziness that you can see in the markets with things like Revlon, and just, you can kind of get a sense, right, that we're getting, I don't know, some craziness in the markets. But I mean, I guess that's normal, right?
Well, I think we've rapidly gone from inflation to now we're starting to see signs of a real slowdown. We've got copper prices are falling off a cliff. Wheat prices are falling off a cliff. Oil's coming down. So I think that is the sign that the slowdown is worse than, worse and sooner. I mean, when we start showing the charts, I'll show the people what I'm talking about. But yeah, so there's definitely some troubling signs. And I think a big thing that's going to happen is that people who don't really follow the market are going to get their quarterly statements, because we're coming up on the end of the quarter here, and they're going to open up their statements and see like, oh my gosh, my account's half of what I thought it would be. So what happens in that case? That's called what we call the wealth effect. People will think, well, I'm losing money, so I'm just not going to go out and spend. So that'll be another negative impact on the economy. But yeah, so I'm starting to see some real signs of things really kind of slowing down. And when I first started writing about inflation back in August of 2020, because that's when I first saw it, I don't know why all these supposed gurus over at the Fed didn't. I saw it in the copper markets, right? How much copper increased from March through August. And copper is a really good indicator of the economy, and it's been in a free fall. As a matter of fact, it's fallen so much that I think it's probably time where some of these stocks might bounce, and could be some trading ideas there. So that's one of the things that we talked about in the class today. And there's also a massive rebound going on in utilities. So for the traders, there's going to be a lot of opportunities in the utilities stocks, Rodrigo.
Right. There's definitely a lot to, and look, here's the thing, man. Like if you started to trade, a lot of traders came in like in 2020, like during COVID. And I guess everything was going up at that point, Mark. So it was pretty easy, like, at that point. But now we're starting to see, retail traders where, to be honest, the markets are pretty tough right now, and like kind of winging it, winging it right now is a lot different than winging it back in 2020 when everything was going up, right? And QE to the max.
Yeah, I mean, everyone's a genius in a bull market. You know what I mean? And people think it's easy. And I guess I get a little emotional when things happen like last year with the all these Reddit traders all think that, I can out trade Steve Cohen. I bought one stock and it went up, and they think that they think that they know what they're doing. And they don't, and they got crushed. And I mean, I don't want to say I'm glad that people, I'm not. It's not like I'm glad people lost money, but I think a lot of people had a really rude awakening to realize that, this isn't easy. It's easy when things are going up, but when things start to fall apart, like they have been, it gets a lot harder, at least emotionally. But one of the things that we teach in the class, and that has done very well over the last what is it now, 6 months now, because we first started to get bearish in around December or late November. So there are ways to profit when the market is falling that are not complicated. You can just buy ETFs that are designed to go higher if the market goes lower. So right. I'm a little like another thing I've seen a lot where I broke my rule of not letting myself watch the financial news, but I was watching the financial news, and it kind of really makes me just question how many some of the stuff I see, because there's all these pundits saying, like, you should go to cash, you should go to cash, you should go to cash, you should go to cash. But if you think the market's going to go down, why would you go to cash? Why wouldn't you buy an ETF that goes up while the market goes down? And as a matter of fact, Rodrigo, markets go down faster than they go up. So in a lot of ways, it's easier to make money in a down market for traders.
Right. No, absolutely, man. Do you want to go ahead and share your screen there, Mark?
Yeah.
And you can kind of show the folks a little bit. So and by the way, you're a CMT as well. You're a chartered market technician, correct?
Yeah. Yes, I am. All right. So I'll just show you just some of the things that we kind of do, right? So we go through the markets, we keep our eyes on various commodities. And even if you're not a commodities trader, don't let that scare you away. So don't let it scare you away, because a lot of the students that trade commodities are not actually trading the actual commodity. They're trading the ETFs that are designed to move the same way the commodities move, or in the opposite direction. So this is one of the reasons why I think we're going into like a real slowdown now. So this is copper, right? And look at that. You don't need to be a chart guru, right, or a ninja warrior trader to see that that's a big move lower. Now, I first started at the place I was at before I joined Benzinga. I first started writing about inflation, and and I publish articles and everything, so I'm not, it's verifiable. I think it was like right here, and we had this huge move in copper from 210 all the way up to 294, and that tells me that we're getting into an inflationary environment. And then here, when all these idiots were talking about how inflation is transitory, like, look at what was going on in the copper markets, right? Like, I guess they don't have charts over at the Federal Reserve. Powell should take art class here. But look at these moves that were going on while they were saying inflation was transitory. But now here we are, and we have the exact opposite. We have this kind of in a free fall here. So this is probably due to an economic slowdown coming faster than we think. Now, all that being said, when things get this oversold and they get to a level that could be support, they tend to bounce. So there could be some tradable ideas there within the copper companies. So the reason why there's support around this level here, I'm going to call it 370, is because it was a resistance level back here, right? Sometimes resistance levels turn into support, and it seems to have happened here because it's not a coincidence that this is where the selling has kind of petered out. The traditional thought behind this is that people sold back here, and then when it went higher, they regretted selling, and they tell themselves, well, if it gets back to the same level, I'm going to buy it back, right? So this is copper, the commodity. Now, I think a potential trading idea here is some of these copper companies, right? So this is Southern Copper Corporation, right? Now, these things clearly follow copper, but we can see things here, that are market fundamentals. Like there are some price levels that are more important than others. That's one of our classes, is we talk about why a level is important. Why would a level that was support here be support here? Why would a resistance level turn into a support level? So we go over the fundamentals, and then we look into the market to see if we can find ways to apply them in real time. So one of the principles of financial markets is oversold stocks that get to support tend to bounce. And we could see that happened right in here. Now, every stock has its like normal, or even not just stocks. I typically say stocks because I was primarily a stock trader, but whatever I'm saying now applies pretty much to any market. Cryptos, we have a lot of options traders in our school, and this would be like a perfect example of a potential options trade here, right? This thing is really oversold. That means it's trading below what would be its usual or typical trading range. And we care about that because when things get to extremes, they tend to reverse. So as traders, when we hear something is at an extreme, oh, well, it's an all-time high, it's a 20-year low, we pay attention because things reverse. So we have an oversold stock that has found support. Now there's a good chance it reverses. Now this support could break and it could keep going lower. Just because it's oversold and at support is not enough of a reason to buy it. We want to buy it and there's no guarantees, but to put the odds more in our favor, we want to have what we call a trigger. So trading models, which is another one of our classes, that's class number 8, where we talk about how to develop trading models and strategies. We talk about what are the components of a trading model in general. And we generally have what we call a setup, a trigger, and then our exit strategy. So the setup is what, if you were like at a race and the starter says, get ready, get set, that's where we are now, but we haven't gotten the go yet because there's a chance this breaks down. So what we want to do is forget about catching the exact bottom, because that's never going to happen. And if you get it, it's probably just luck. We want to wait for the trend to reverse and then jump on board while it's moving along. So we need something that we would call a trigger. So I would think that you could say, well, this RSI indicator, which shows momentum to be at an extreme because we're below this lower range, if this starts to turn and go higher, that's going to tell us that we're not as overbought anymore. And when things aren't, I'm sorry, did I say oversold? And when things are not oversold, that could be the first sign that it's starting to bounce higher. So we have a setup being oversold and at an important level, and then we would have the trigger there. So there are other copper stocks that that we looked at that don't look as appealing. So this is Freeport McMoran. And, I mean, I guess if copper really reverses, this would too, but to me, this is below this level here, whereas that Southern Copper Company is above it. So that's one of the ways we look for ideas. We look for things that are at extremes, overbought, oversold. And it could be as easy as looking at a screener and just getting a list of stocks that are oversold, and then looking at the charts. And if you see something that's oversold and it's at a level that was support before, well, that's a potential trading idea. So we have, a lot of the students have like a trading watch list, and the watch list doesn't just consist of all random stocks. The trading watch list is stocks that are set up, stocks that look like they're going to make a imminent move. So if you find 10 or 20 stocks that are overbought or oversold and at support or at resistance that look like they're going to move, that's your watch list, is the stuff that you have set up. And then you got to just figure out what your trigger is, and maybe you can get some kind of email or notification or whatever, depending on what place you use. But yeah, so that's the idea there. Too many people just try to catch the bottom, and that's why they run into problems. So the idea is, it's like, like just pretend you're at a train station, and you don't know if the train's going to go north or south, right? And you want to go north. Well, if you just jump on without knowing which way it's going to go, maybe it's going south, and you're in trouble. If you wait to see which way it's going and say it's going south, so you know not to get on it, or if it's going north, then you decide to jump on it. You just kind of jump on it after it started moving. And that's what we're kind of doing here with this momentum kind of trading. We're jumping on after the trend has already turned. So, you're never going to get the bottom price, right? The greatest traders in the world don't get the best price. The best basketball players in the world miss shots. The best golfers in the world miss shots. People come into this, and I think another problem people have is that they come in here thinking that, oh, like a guy like Steve Cohen, he's right on every trade. He's got this like secret system that always works. And that's just not the case. I mean, the good investors, good traders, they lose money too, right? But the difference is the ones who are successful have the emotional discipline to follow their plan. It's all about investment psychology. Like, that's the real secret. That's why a lot of people can develop profitable trading strategies with what we call paper trading, where you're just trading on paper. But when you get real money on the line, that evokes your emotions, and that makes you do things that make you lose money, like guess, like panic. Like, look at the Southern Company right now. It's traded 1.2 million shares today. So people are just dumping this thing because they're panicked, right? There's a good chance that tomorrow this is up to 51 or 52, but they're just in a panic, So that's why, that's why it's important to understand the psychology, right? All these moves, well, not all of them, but the vast majority of these moves, what has happened? Why would the valuation change from, say, here to here? It's not a lot, but it's a big company. And what has changed? Have they developed a new product? Was it earnings? And the answer is nothing other than investor perceptions. So when we look at these markets, we have to understand, when we look at these charts, we're looking at, we're looking at big pictures of investment psychology. People think that chart reading is like, it's like astrology or reading tea leaves. And for some people it is, because they don't know what the hell they're doing, right? And I see that with a lot of people even people who are, more well-known, you might see in the media. And I think the reason probably why I have a much better, competence at it or grasp of it is because I don't just look at charts. I spent 20 years actually trading and actually utilizing charts. And, in the hedge fund world, we're trading big positions. I mean, for me to get a million share order was nothing. I would do stuff like that every day. So you get a million shares of a stock to sell, you better know where the buyers are and you better know where the sellers are. So the philosophy of this class comes out of, my experience of what we would do at the hedge fund, at the morning meeting at some of the funds I've worked at. But let's just go here because this shows, I think this is a good example of
really quick, Mark, here, before we do pop into all that stuff. By the way, great stuff here, man. The people love it. I want to give a shout out here to Sandy. Sandy, welcome to the Benzinga Trading School. Newest family member here. Let's go.
Hi, Sandy.
But yeah, dude, we have Born to Be Free in the chat. He's saying Mark has changed my life, and in this class set, I learned so much. He has a new way of delivering the information in a simple, easy to understand way. Join us. Born to Be Free has been a great student there, among some other folks there as well. Kevin Mosley says Mark's the man, always easy to follow and understand. Nick Levis says this guy rocks. So yeah, I mean, people are showing the love today, Mark.
Well, yeah, well, hey, man, I appreciate it. Makes me feel a little subconscious or self-conscious, but anyway. So let's look at this, and because this chart here can show you about investment psychology. All right. Now, I would almost guarantee that 98% of the people who are listening to me who trade have bought a stock and watched it go lower, and then they tell themselves, I want to get out of this. I made a mistake, but I don't want to lose any money. So what they do is they place their sell orders at the same level that they bought them at, right? A lot of people I know are listening to me saying, yeah, I do that. That's happened to me. So why does that happen? Well, it happens because of psychology. And this is why one of our classes is based on investment psychology, because it's probably like the real key to being successful. Like you can look at all these lines and you can look at all these charts and you can look at all these patterns, but if you don't have the emotional discipline to stick to it, it's not going to work, right? You're not going to be successful. And I'm not saying you got to master your emotions like you're some kind of Buddhist monk or something, but just being aware of it. So now we can see this here. This is a fundamental of markets. Levels that were support can become resistance. And again, you don't need to be a chart guru to see this. Very clear. So people buy here. When it goes lower, a lot of these people tell themselves, hey, I shouldn't have bought it. I want to get out. I'm going to place my sell order at the same level I bought it at. And if there's enough of these sell orders, the level that was support converts into resistance. And knowing where these important levels are is how we can make good trades. We can catch trends. We can use them for targets. Like say, for example, you just happen to buy this thing down here at 148 and it's going higher and it's going higher and it's going higher. And you tell yourself, hey, man, I got this great idea. If it gets to 165, I'm going to sell it, right? And then what happens? It gets up to here to 164 and it rolls over and goes lower. And you just missed out on a profit because you didn't understand or know how to look for resistance or support. So, then obviously you can take it the other way. When something gets to support, that's when we start thinking about buying it. But again, we have support becomes resistance. So this level of support here has been kind of the top of the trading range over the last few days. So by understanding these basic principles of how to identify important price levels and understanding momentum is that's where the success comes from. It doesn't come from having these crazy mathematical systems. Like a lot of people, I use this analogy a lot, and because I think it's very fitting. Like a lot of people who are kind of just starting out, they tend to overanalyze the market, and they think it's like a chess game, and they try to figure it out like from a mathematical perspective. And that's just not how it works. That's why all these big hedge funds that were all getting into AI, 5 years ago, like the performance of most of those funds has really been pretty weak, like really almost abysmal, because they think that they can figure stuff out with math. But in reality, there's a person on the other side of the trade that has an exact opposite opinion of you. If you buy a stock, somewhere out there, there's someone who's selling it because you think it's going to go up. They think it's going to go down. But if you don't factor in all this emotional stuff, you're just never going to understand how these markets work, because people are irrational. So what works today might not work tomorrow. So a better analogy than chess, I think, is like a good poker player, right? Because a good poker player understands how to read people's emotions, right? And if you're playing poker today and then tomorrow you play poker against the same person, it could be a completely different feel, because maybe something happens that sorry, yes.
Yeah, no worries, man.
Guys, I'm just going to take a 30-second break so I can go get some water. So I'll be right back.
Okay, yeah, no worries, Mark. Well, in the meantime, a lot of you guys are asking where you can join the school. So for you guys that are on YouTube, just know that it's like on the chat. It's posted. Basically, everybody that joins after the 7-day trial gets a free laptop, and it's annual. And after the 7-day trial, it's $14.97 for the year. The live sessions Monday to Thursday, 7 to 9 a.m. Eastern, live with Mark. And Friday from 12 to 1 p.m. And Friday as well. You have 2 hours Friday. Now, the chat room schedules are live. That's Monday to Friday, 24/7, basically. The chat rooms are always live. So good questions there. But let's just wait for Mark. Oh, I think Mark's there. You're all good, Mark?
Yeah, I'm back.
Yeah, man. Hey, really quick, man. So what are your thoughts on the energy sector? It's a pretty convoluted market right now, right?
Well, like I said, I think we could be going into this could be telling us that this slowdown is coming faster and quicker than people think, because the only thing that's going to make oil go down is if more oil comes onto the market, and we know that there are problems with drilling, so a lot of new oil is not coming in, or if there's just less demand. And this could be, if this is going down because there's less demand, it's telling us that, hey, the market, this economy is really starting to kind of come apart, and that's not surprising me, because there's some really messed up stuff going on. And as Born to Be will attest, we've been bearish for a while, and there are some good reasons to be bearish. One of the things that we kind of do is we do like a little bit of brainstorming, right? And I follow this, I don't know this guy, but he's a CMT too. So I follow him on LinkedIn, and there's some really interesting stuff on here. I guess they're money managers, but I was reading this here, which he just put out, and there's just some charts in here that are going to make you kind of be like, wow. All right, so let's go down a little bit here. So this kind of struck me, right? So this is the value of the market to the GDP ratio. And look where we got in the dot-com bubble, right? Look where we got in the financial bubble. Look where we are now. So, this is telling us that the market could really start to come apart. And a lot of this is because of this monetary problem. So don't listen to what, to the stuff you hear about, Putin's price hike and all that kind of stuff. This is money supply, and this is your CPI. So as more money comes in, that inflates prices. So that's the main reason why why we've seen this inflation, is because the Fed overstimulated. They sent out too much money. So when you have too much money, but you have the same amount of goods, things start to cost more. right? If you have in a closed economy, in a theoretical, like an economic model, in a closed economy, if you have $100 and 10 goods, those 10 goods are going to end up costing a total of $100. If you pump another $100 in there, those goods will eventually cost $200. So that's why this inflation is monetary driven here. That's a big part of it. The other big part of it is the rise in oil because of the cutbacks that we've made here in the United States, where I think we're producing like maybe only 25% less oil than we did before. So these are the two things that are going on that are driving things higher. So now the next question is, well, where could the market go? Right? People are probably saying, well, man, this guy's really scared the hell out of me. Sorry, I don't mean to. I just say it like it is, man. I just say what I say what I mean, and I mean what I say. Sometimes, I guess. I'm going to just show you this chart here. We're going to go to a 5-year chart of the S&P 500. All right. Since 1929, there have been 25 bear markets. That's a definition of we get to a peak and then we drop by more than 20%. The average amount of the sell-off in these bear markets has been 35%. So, 25 bear markets, the average sell-off is 35%. So if we go down 35% from our peak, that's going to put the S&P, or this is actually the spider, which follows the S&P, that's going to put this down to around 310 or 320. Just coincidentally, or maybe not coincidentally, because this is one of the things about how markets work, if we get down to around 320, the S&P would be in line with its historical valuations, right? So we could keep going lower. And also, coincidentally, or maybe not coincidentally, it's one of these mysterious things about the market here. If we go back to 2020, we talk about our important levels, right? And like what at my previous job, I was actually writing here too about how it's time to buy. And the reason why I was saying that is because we got to a level that was support back here in December. So just by seeing that we're oversold and we're at this level here, I was able to I think I published my article like the day after the bottom, right? It's time to buy. And I mean, I'm not bragging or anything like that or taking a victory lap. I'm just trying to convey the message that it doesn't need to be that complicated. Just understanding some momentum stuff, understanding how some levels are more important than others. But anyway, going back to talking about where the S&P could potentially get to. So like I said, if it's an average bear market gets down around 320, 320 would be fair valuations. And look at this. This 323 level was really important. So this was a level I was keying in on back then. This is the last area of support before we have the COVID crash. So the market rallies. Where does it find resistance? At the level that was support. Buyer's remorse. People bought here. You see the market crash. They're like, oh, I want to get out. If it gets back to my price, I'm selling. Support turns into resistance. Then we had resistance here. Then resistance turns into support. People sell. And when it goes higher, they regret selling. And they tell themselves they're going to buy it back. And they don't want to pay more than they sold it for. So they place their buy orders at the same price they sold at. And if there are enough of these buy orders, the level that was resistance can become support. So much of successful trading is knowing where these important levels are. I mean, that's, it's, if you don't know where these important price levels are, it's like you're going to be in a town where you don't have a map and you don't have a GPS and you're supposed to figure out how to get around. But I can understand why people think that charts are mysterious, because a lot of people that are chartists or technical analysts, they don't really know what they're doing. Sorry about that, my brutal honesty. But I guess I don't know what it is. I guess maybe because they don't have the trading experience. that I do. But one of the things we do in the class is every day we go through the various sectors, because this S&P 500 consists of 11 different sectors. And by going through the sectors, we can get insight into what's going on in the broader markets. And that also can lead us to some trading ideas. So I just noticed this. So this is our Spider ETF. Spider's just the brand name. It's run by State Street. But there's an ETF that tracks each one of the sectors. So by looking at these ETFs, we can get insight into what's going on. So look at this now. Utilities got massacred here. What happened? Where did they find support? At a level that was support before. So I know this is hindsight, but oversold at support, things that are oversold and at support tend to rally. So we're oversold. Now, being oversold and being at support may not have been enough to get into the trade, because maybe this breaks down and goes lower. But what we do is we wait for a reversal to start. And your reversal, you could have your rule as, all right, well, if RSI gets below this lower range here, let me make that easier to see. So remember what I talked about, right? We have to have a setup and our trigger. So the setup is that where we've reached a level that has been support and we're really oversold. The trigger is, all right, this RSI comes back and it gets back within the range. So that would have been your trigger to get in here. Now, this is an aggregate of the utility sector, right? And well, actually, before I go into that, I would say my price target here as a trader would be right up around here, because levels that were support can become resistance. But this is an aggregate of the sector, right? So just by the way this is designed, there's going to be stocks that are probably going to move more, and there are going to be stocks that move less. So to get an idea of what is in this particular sector, we go and look at the fact sheet, the utility sector Spider, right? It's run by State Street. And then we can go look at our holdings, and we could start looking at some of these companies for potential bounces. Oh, Rodrigo, I think actually this was one of the trading ideas that I posted in the chat the other day.
Yeah.
SRE, let's see what that's doing.
Yeah, Mark, and let me ask you a quick question here. So like, because as a retail trader, right? And I know a lot of people have this question too. As an example, let's just say like if a company has like, let's say a free float of like, let's say 7 million shares, something like that. But they trade like, I don't know, 160 million shares or like some insane volume like Revlon. Like how does the math work there? Like on that end?
Well, it's just a bunch of day trading. So all the shares get traded more than one time. So people are just trading back and forth. So I mean, in theory, something could have a volume or a float of 1 million shares, but if people just trade it back and forth all day, it could trade 20 million, 30 million. It's the volume isn't really the amount of shares. It's just the amount of trades that are done. So sometimes when you get things like this, you can get that. Let's see what we got here. Average volume 75 million. So this was I guess a short squeeze, right? I think the short interest here was like 38 or 40%. But notice where the squeeze ran into resistance, right at $10, the level that had been support, right? Pretty clear support actually. So when you're trading something and you're long and it's going higher and you're wondering, where should I get out of this? What should my target be? Well, one of the things that you do is you can look into the past, because that's what this is, and look for levels that were important. Because if they were important support or resistance before, there's a chance that they're going to be important support or resistance again. So a lot of times when these short squeezes end, the stocks really just kind of collapse. And it looks like that's what's going on here. So yeah, I know this was
yeah, I saw this lady Karen Finnerman on CNBC, she was saying that like there's no shares available to short. Watch out, this could just explode, something like that. But
Yeah. When did she say that back here?
I think it was yesterday.
Oh, really?
Yeah.
Okay. Well, if she made it yesterday, that was not a good call. If she made it before yesterday, it was a good call. But what happens when we're talking about short interest, right? People that think a stock is going to go down might sell it short. And what that means is they borrow the shares from someone else and they sell them with the promise that in the future they'll buy them back and they'll return them. And you might be thinking, oh, I would never lend my shares to anyone. But if you read the fine print of your brokerage agreement, it says in there that if your shares are in a margin account, they can be lent out. So when people want to short, you call up your broker and you say, I want to sell this short. They go and they see if there's shares that you can borrow, right? If there's people that are willing to lend you shares, and the vast majority of time there are. So a lot of people were short this, but then we had this news come out that there's a company looking at it to potentially buy it out. So it started going higher, and it started going higher and higher. And now the shorts are starting to lose money because they sold it at a lower price. But the traditional short squeeze definition is that people that were long the shares that lent them out demand the shares back so they can sell them. And that makes the shorts go into the market and buy, which drives the price up. And it turns into this cascading effect where as it goes higher, people demand their shares back from the shorts. So it forces the shorts to go out and buy. And when you get these short squeezes, you can get these really rapid moves higher, right? But when the short squeeze runs out, we get these big reversals because everything kind of just comes back to earth. Because this almost can be seen like panic buying by the short sellers, because as things go up, they're starting to lose more and more and more money. So they start to panic, and it ends up being like this buying crescendo. It's the opposite of it's a capitulation, but it's like a capitulation to the upside. It's like a capitulation to the downside. Like here is people saying, oh man, I don't care, just get rid of my shares, I don't want them anymore, I don't care what the price is, just throw them out. This is kind of the opposite, right? It's like, oh my God, I'm losing money, I'm going to go out in the market, I'm going to buy my shares at regardless of the price, because the short squeeze is coming and I might get called in and so forth and so on. So that's pretty interesting. So every day we come across different stuff. We go through the news, see if we can find ideas. Rodrigo, a lot of our best ideas come from our students, actually. So that's been a pretty cool thing to watch.
Yeah, a lot of the students learn a lot, and look, these are things like that, like if there's a short squeeze or anything that's happening in the markets, what I like is that you cover it with the students, you analyze it live with them, which is, that's next level stuff.
Yeah, well, here's the thing, right? It's like everyone's a genius in hindsight. So, when I was looking at a lot of these different trading schools, when I was like doing the research, a lot of it is like, oh, look at this great call I made back then, or look at this great call I made then. But it just is so much more important to like do it in real time. There's like a lot of different analogies I can use, and some of my students love them and some of them probably don't love them so much. but it's almost like, like say you're training to be a boxer, right? You can do all the exercising you want. You can work out, you can do your push-ups, you can be like Rocky and go chase the chicken around the junkyard. But until you actually start looking at the market in real time, you're not going to really see what's going on. And I think the real-time application is a cool thing to watch, right? Because markets act different at different times. Now we have our 8 classes, right? Levels. There's always going to, as long as there's financial markets, there's always going to be important price levels, or levels that are more important than others, I should say. Momentum, trends. Markets are always trending. They're always going up, down, or sideways. We cover investment psychology, which we mentioned. We cover how to go through all of these various sectors, but the fundamentals aren't going to change. There's always going to be certain price levels that are more important than others. But what does change is the way the market acts. Like the market acted very differently up until November because we were in a bull market. But then we started to, now we're in a bear market, and now they finally realized that we have all this inflation. But this is a healthcare sector, and this is actually making a nice move here. So this could be on the verge of a breakout. But this could be a flight to safety, right? But anyway, I just want to show this because this is a really good example of how things are different, right? When we get to support and we have a really big, powerful move like this, it tends to be a bullish thing that follows through. But when we get to a resistance level and we have a big move like that, that tends to be bearish. And in this case, it certainly was. So the people buying it aggressively down here are the ones who are right. They're catching the bottom. The people that are buying it here are the people that are patiently waiting. They think it's going to come in. They think they could get a better price. They put their limit under the market. It never gets filled. Their orders never get filled. Finally, up here, they say, what the hell with this? I'm just going to go out and buy it. It's almost like capitulation buying. So markets act differently at bottoms than they do at tops. So by going through a couple of different cycles, and since the class has started, Rodrigo, I mean, what have we seen, man? We've seen a lot. Inflation. When we started, we were right in the very end of a huge bull market, and now we're in a bear market. So things act different at different times. That's an important thing to remember. And I want to show you guys something which gave us some insight that the market was starting to get weak. Well, actually, I'm going to go back to this technology ETF here. All right. So technology peaked in late December, early January. All right. This is the technology sector. This is the biggest sector in the market. Now, what was going on here was there was a lot of negative, I guess we could call them market internals, or a lot of different signs of weakness right up around here. But here's what happens. You have these big tech stocks like Microsoft, Apple. There's such a big part of the index that it masks the weakness that's going on. Because say this is, I don't know, just say hypothetically, it's 100 stocks. Well, Microsoft and Apple are probably going to be 20 or 25% of it. So people could be selling 85 of the stocks or 90 of the stocks and putting the money into the 10 big ones. And because of the way the index is calculated, it masks, it looks like things are still going up, but in reality, things were really getting weak here. So one of the things we look at in the class is this particular ETF, where every stock in it has the same weighting. So this thing is not going to mask the weakness, because in this, the smallest stock in the index is the same, or, in terms of market cap, has the same weight as Apple. And look at this. I mean, you have a clear trend break in November, right? And this is where we started to get bearish. And people like to talk about the market's going down or whatever, but different sectors go down at different times. The entire market doesn't just crash at all at once. So by looking at things like this, we can get insight into what's going on. And now we have our technology sector, which peaked in December, right? Well, while this started to go down and really started to fall apart, where was the money going? And it was a classic flight to safety. People say, all right, well, technology is risky. I'm going to sell my technology stocks and I'm going to go buy healthcare stocks, or I'm going to go buy consumer staple stocks, because those are companies that are going to perform well even in a bad economy. So the technology here, we peak here. Now look at our healthcare stocks. we peaked here in April. And consumer staples, we peaked here in April. So by watching these different sectors, it gives us an idea of what's going on in the broader market. And then we could take it to the next level where we watch the stocks that are in the ETF to see how they're going to influence the ETF. Now, I think that, I don't know, I think that out of all of the stuff that I do, I think that this is probably the most value added thing, is just watching these sectors and see what is going on. So like this right here is going to be very telling. This is our financial sector. So we've been testing this resistance. You know, is it going to break through? Is it not going to break through? And I'll give you guys a good example of what I mean, right? So there's certain things that different things drive the market at different times. So we have, this is the S&P 500. We can see we're really not doing anything today. This market will not make a significant move higher unless Apple clears this 137 level. All right. And what we were saying in the class in the early part of the month was if Apple doesn't get above 151, the market's not going higher. And sure enough, that's what happened. So 151 was support here and it became resistance here. Now we have support here and it seems to have become resistance here. So if this resistance really starts to break and Apple starts to move higher and gets to say 138, 139 and holds there, that's going to be a signal. That's going to be the market telling us that the market's going to go higher. So one of the most important things, Rodrigo, that we key on, right, is we let the market tell us what to do. We don't guess or try to pull ideas out of thin air.
Right. I guess that's the best way to get trade ideas, to formulate them through your own thinking, right?
Yeah, like for example, you know, we got this trade idea in copper, right? I mean, just by watching copper, like I didn't think last night, oh, I'm going to go recommend we buy copper stocks, but when we see this copper meltdown, you know, it just tells us to be on the lookout. But as we're going through the markets, if we see that, wow, look at that big reversal in utility stocks here. So if utility stocks are rallying, we know that a lot of the stocks within the industry or within the sector are going to be rallying. So this is the trade idea I put in chat. I think it was probably on this day or this day, but sell off or, you know, oversold, reached a level that was resistance and we bounced. And it's just really that simple. I didn't really come up with, you know, any like, you know, super secret formula or anything like that. You just see something that's oversold and it's at support. Now, what could be your exit strategy? Well, now you can tell yourself, well, if we get up to here, this is going to be my target because it was a support level. But I'm going to just put this trend line here. And this is how you can lock in profits. A lot of times people have profits and they you know, they end up losing them because they don't know what to do. So you get in here and you ride this, and if it crosses the trend line, you sell it. It's not as good as getting up to your target, but it'll keep you from potentially having a loss. So within this sector here, let's look at some of these other things. Exelon, I haven't looked at that in a while. Let's take a look at that. All right, so resistance becomes support. Got a little bit of a move here. This looks like it's got some room to run here. You know, it's when stocks make these big moves lower or fast moves lower, sometimes when the stocks get back to that price range on the way up, they make fast moves. So this looks pretty good. What else is in this sector? Oh, Con Ed. 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 Oh, wow, look at the move this one's made. Right? Look at that. So you don't need to be a market guru to see this, right? Look at that. I mean, to within points, 87 resistance, 87 support. And we got a big move here. So that's a nice reversal. It might hit some resistance around here, but yeah, so this is one of the things that we can come up with ideas. It's not like some super secret strategy. We just look for sectors that, as traders, right, we want things that are going to look like they're going to make moves imminently. Stuff that's overbought, stuff that's oversold. So if we find a sector that looks like this, right, just let's go back in time to Monday. Oh, it looks like we're going to hold and we're oversold. Oh, and we got our trigger. We got back into the RSI range, right? So when you see stuff like that, we can look into the sector to look for stuff that looks like it's going to move more. We want to have our capital deployed in the best way possible. And what I mean by that is this thing today is making a 2% move, but there's probably companies that are moving even more. Like this is up 2.7%. So when we see these sectors, what we do is it's okay to trade the ETFs. We have a lot of students that do that, and there's no right strategy. Everyone's a little bit different. So what works for some people might not work for the others. But this is it's kind of like just brainstorming, right? We just kind of go through the market. And a big part of it is letting the market tell us what to do and not guessing. Most of the people that I talk to, when I say, why did you lose money? They say, well, it's one of two things pretty much. They guessed, or they had a plan, but they didn't stick to it. And that goes to our investment psychology class, which I think is pretty cool, Rodrigo. It's and it's kind of like some of the lessons we learn from trading apply to other areas of life too, like not being caught up in the crowd and so forth.
Right. So I'm just going through the comments here. So Mark, basically, why do you think the investment psychology is just such a popular, it's my favorite class, but why is it such a popular class among the students?
Because most people lose money because they make emotional decisions. And for example, there were people who were in a complete panic 3 days ago that were puking this thing out. Now it's higher. I'll bet you a lot of these people are saying, oh, I shouldn't have been panicked. News isn't as bad as it seems or whatever. But we have evolved an emotion that's called fear, right? And it's got to have some kind of evolutionary reason for it. Like you're walking down the trail and like a woolly mammoth comes after you, you get afraid and it makes you laser focus and it gets your adrenaline pumping and maybe it makes you run faster, right? So for some things, fear is good, but in the market, it's not. And when people get a position, there's this fear of losing money. So it makes them do irrational things. I told you before that, the best traders have losses too, right? But here's the thing. You're going to have break-even trades. You're going to have small gains, small losses those are all going to offset themselves. And you're going to have big gains and big losses. Well, the people that are successful are the ones who don't have the big losses. If they worry about the bad trades, the good trades take care of themselves. So I'll give you just an example here, right? If you have a paper trading strategy, paper is, paper strategy, paper trading is easy. It's easy to come up with things that work. But say your paper trading strategy tells you, all right, buy 1,000 shares at 10 and sell it if it gets to 15. Well, on paper, it's easy to sit there and just watch it, right? Because there's nothing on the line. But if you have real money on the line and your stock gets to 11, it's like, wow, I got $1,000. Now it gets to 12. Wow, I got $2,000. I'm going to sell. $2,000 is going to cover some bills. And then the stock goes to 15. So you sold it too soon because you were afraid that you were going to lose your profit. So the successful traders are the ones that have the mental fortitude or the emotional discipline to have enough confidence in their system that they're not going to second guess themselves. And then the same thing goes the other way. If people buy something and it starts to go down, they say to themselves, oh, I'm going to wait till this comes back up. And then we get that situation like we saw where support converts into resistance. So that is why psychology is so important, because the fear of losing money makes people do irrational things, which they come to regret, right? Most people, right? Wouldn't you agree with this, Rodrigo? Most people, when they come to the class, and they say, when we ask them why they lost, they say, well, I guessed, or I didn't stick to my system.
Right. Really quick here, want to give a shout out to Trent. Welcome to the family here, to the trading school, Trent. Let's go.
Welcome. Yeah, so then one of the other things we do is, we go through the Benzinga Pro news, just see stuff that, might stick out. FedEx. I think FedEx is reporting today. And one of the things, sometimes we look at companies' earnings, we're mostly technical traders, but sometimes you can get insight and good insights by reading earnings of companies like this that are kind of like, like a benchmark. Like by going through this report, we're going to see like, they're going to be talking about supply chains and inflation. So sometimes we go through earnings, and a lot of times the students will ask like, hey, can we take a look at these earnings? Like, what do you think? What's there to look for if you're a fundamental analyst? Well, you look for trends, you look for operating margins that are increasing, you look to make sure you don't have a lot of goodwill. So it's a class. There's a lot of interaction, there's a lot of discussion. At least that's what I like to have it, because I want people to think for themselves. I don't want to really tell them what to do. So that's the concept here. Is if you join the class, I think you can teach yourself to be successful. You don't really need to rely on some super warrior ninja guru trader, right, Rodrigo?
Right.
So you want to do people have any questions about stuff in the market?
Let's go here to the chat on YouTube. So Brandon Mascarell on YouTube says, so will money shift to small caps?
Let me see here. These are small caps. No, not yet. Actually, the money, when we start to make the turn, the money will be going into those names that are considered safe. So I don't think it's going to go into, I don't think it would go into small caps. So I would say no. Over the last few days, money has been going into the bond market. And then maybe I would say over the last, since the beginning of the year, a lot of the selling, the money went into commodities to chase the commodities trade higher. So I think that's where we're going.
Okay. All right. And what do you think about Tesla?
Well, I would assume in the long run they'll do pretty well, but just from a technical point of view, we got some pretty clear levels here, right? So, this is kind of forming a range, and once again, we can see how support turns into resistance, and sometimes these support levels can stay intact for a while, right? So I don't know what your time frame is. My time frame is usually more of like a swing type trader-ish, holding for a week, 2 weeks. But I would just think, all right, well, if we get back up to around 765 and it doesn't look like it's going to break through, then you get on the short side. If it gets back down here to around 625 and the support holds, you can look for a potential bounce. So that's how we trade things that are in ranges. basically when you have something that's range bound, there's two schools of thought, right? It's like certain traders want to just trade within the range, meaning sell if we get to the top of the range, buy if we get to the bottom of the range. And then the other school of thought is buy the breakout. So, we have support here. This is a support level. What is support? Well, support's a large concentration of buyers. As a matter of fact, there's so much demand for the stock, or there's so many buyers that downtrends end at them. When a stock is trending lower like this, people are selling, but there's not enough buyers to absorb all of the shares. So the sellers have to take lower prices. Like someone might come into the market here and say, hey, I got 1 million shares. I want to sell them at, I don't know, just say 1,000. Well, maybe there's just not enough buyers around to buy 1 million shares at 1,000. Maybe there's only 500,000 and you got to sell your next 500,000 at say 990. So if there's not enough demand to absorb the supply, we see these downtrends. When we get to what we call a support level, the dynamic changes. There's enough demand that sellers can sell all they want to without pushing the price any lower. So that's why these downtrends enter them. Now, if we get below this, what we would call a breakdown, it tells us that the buyers who created the support are gone. They've either finished their orders or they've left the market, but either way, they're out of the way. So when you take a large amount of demand out of any kind of market, it sets the stage for the prices to go lower. On the upside, resistance is a large group of sellers, and it's just the opposite dynamic. When people are buying and there's not enough supply to fulfill all the demand, they have to pay higher prices. Someone might come in and say, I got to buy, I want to buy shares here at 680. And, there's just not enough around to fulfill all the order. So they have to pay a little bit higher. Now, when we get up to a resistance level, right, everything changes. There's enough supply to fulfill all the demands. Now, if we get above this resistance level, what does it tell us? Well, the sellers who created the resistance are gone. They're either canceled or finished their orders. So when you take a lot of supply off of the market, it sets the stage for it to move higher. If you take demand off of the market, it sets the stage to move lower. So these, Rodrigo, are these basic supply and demand fundamentals. It really doesn't need to be complicated.
Right. No, and that's really why a lot of people love the school, because you don't complicate it for the students. You try to help them, and that's really the goal of the school, helping retail traders improve their trading, right? Regardless of the strategy that they have, right, Mark? Even if they're trading options or.
Yeah, I mean, for options trading, it's like, I think this is almost kind of essential to understand how overbought and oversold things react. Because if there's no news on a company, the odds are the only thing that's going to make it have a big move is some kind of a longer term dynamic, right? So like, let's go back to this. Sorry. All right, so let's go back to this Southern Copper here. All right, so we have a longer term dynamic. We're really oversold and we're at support. When markets get to levels that are support or resistance, they tend to make big moves. So I think you can, trading options based on how things react around these levels is a very effective strategy. And it's also a very effective day trading strategy, right? So if a lot of people that are day traders ask me how far back they should look on our charts, and I say, as far back as it takes, because sometimes something that is a long-term dynamic will affect the short-term trading. I think this is a good example here of CVS. Oh, look, now it's rebounded. We talked about this in the class the other day. So look at CVS here, right? This is an eight year chart. They had their earnings here, and where did it stall out? The same level that it did back here in 2015. right? So so it's the same level. Now, this was the day they reported their earnings. Let's look at a little closer up picture here, right? So if you were a day trader and you bought this here and you said to yourself, oh, I got a nice thing here, where should I sell it? Well, it's about to get to resistance, maybe I should sell it, right? If you say, all right, I'm a day trader, I bought this thing at 110, and if it gets to 115, I'm going to sell it. Well, you might have missed out on something because you didn't realize that there was a longer term dynamic in play here. So a lot of the options trading or successful options trading comes due to volatility. And when things get overbought or oversold and they get to support or resistance, things tend to get volatile. So I think that's probably, in my opinion, I mean, there's a lot of different ways to do it, but if I was, day trading or shorter term trading, you got to look at these longer term dynamics, because unless there's news, the stock's really not going to make a dramatic move. So, I guess, Rodrigo, it's almost like the analogy of the Russian dolls, right? You open the biggest one first and there's another one in it. So you start longer term to see if there's any longer term trends or levels in play. And if not, then there aren't. But, like look here, right? Say you're thinking, no, I should buy CVS. What would be a good price to buy it at? Oh, I'm going to buy it if it gets to 85. Well, it might not get to 85, because if you're right that it's going to go up, you're going to miss out because you didn't realize that this particular level here around 90 or 89.50 was important. So resistance becomes support remains intact, and now we have a little bit of a move higher. So I think, Rodrigo, it's people are maybe have an epiphany or pleasantly surprised to find out that it doesn't have to be as complicated as they thought it was, if that makes sense.
Yeah, and I know that's a big relief for new traders that are genuinely trying to, not just even get by, but bring in some additional income. Right now, things are pretty tough and out there for most people. So this is good because it actually helps people find, develop a skill set that can help them bring, income.
Yeah. I mean, it beats it beats being a ditch digger, I guess, right? Some people that I've known over the years have had successful trading strategies that they've developed, and they maybe work an hour a day. I mean, don't get me wrong, they spend a long time developing their systems, but they get their signal, they execute their trades, and then they go do what they want to do for the rest of the day. Go play golf, just do whatever. You don't need to sit there and be glued in front of the screen, but if you can be successful at this, you can make a significant amount of money in a really short and efficient time frame. So I think it's a great skill to have, and I think it's really the people that are really the newbies, it's almost easier for them to learn because they don't have to unlearn stuff. There's so much mythology and misinformation out there that I can understand why people get confused. There's all these myths about, like, what's a market maker, what's an algorithm, what's a dark pool. People just don't really understand. The whole concept of a dark pool is actually kind of funny, in my opinion, because I remember when about 20 years ago, the brokers all started pitching these dark pools. So a dark pool is neither good nor bad. A dark pool is a private stock exchange. So if you're a big firm like Goldman Sachs, you might say to yourself, well, why are we paying the New York Stock Exchange fees to execute our orders down there? Why don't we just develop our own exchange so we don't have to pay those fees? So that's what a dark pool is. It's like a private exchange. So if you put your order with Goldman Sachs, it's going to get executed somewhere within one of their dark pools, probably, as opposed to going to an exchange. Now, when they first came around and started pitching this stuff, because generally the dark pools are made by brokers, and hedge funds and money managers and retail clients have to trade through a broker because that's the law. So you have to pay a commission. So these dark pool providers, I guess, or the people that have the dark pools, they would come around and they would pitch it to guys like me because they want me to put my orders in their dark pool so they get the commissions. But the whole pitch with the dark pool was, hey, it's dark. No one's going to see what you're doing. The trading is hidden. So no one's going to see what's going on. So we call it a dark pool. But that's a misnomer because stuff that trades in dark pools still needs to be reported to the tape. So I just think it's kind of funny that dark pools have gotten this ominous, this ominous reputation for like the exact opposite reason of how they were starting to pitch them, back then. So, and then, then the whole concept of a market maker is something that people are pretty confused about too. And I speak as someone who actually was a market maker for 2 years, so I know what I'm talking about. Now, on this, in the stock market, you have the buy side and the sell side, and those are slang terms. It doesn't mean whether you're buying or selling. The buy side of the market are the firms that need to pay a commission to get a trade executed.
Right.
They're like retail traders, hedge funds, mutual funds. The sell side of the market is the people that get a commission to do the trade. So when you trade through your broker, they get a commission. The broker is on the sell side. So if you're a hedge fund guy or an institutional trader like I was, and you give a big order to a firm like, say, Goldman Sachs, say it's a bank stock, it's going to go to the Goldman Sachs bank stock market makers, and their job is to become, they're experts in the bank stocks. They know all the ins and outs of the bank stocks. They know how they trade. They know the news. They're just experts within that particular sector, right? And that's what a market maker is. I mean, they're not out there thinking like, oh, how can I go rip off the little guy? What they're thinking is, how can I do a good job trading Mark's million share bank order here so he thinks we're good and he comes back to me. He comes back with more orders. So that's the whole concept of what a market maker is. And the reason why they call them market makers is because they make you markets. So Wall Street it's a lot of, back and forth, hide and go seek type of game. So if I call up Goldman and I say, hey, get me your bank market maker on the line here, I got something to do. Let's go find a bank stock here. It's pretty funny. If like we used to do this as kind of like a joke, kind of like a good-hearted joke. But like, say I had a sell order of Goldman Sachs, I would call up Goldman Sachs and be like, hey guys, I got a million shares of Goldman Sachs to go for sale. Kind of immature humor there. But it would be pretty funny. But hey, if they're going to get the commission, they're going to take the trade. All right. So anyway, so say I call Goldman Sachs and I say, hey, let me get your bank stock trader on the line here. I'll bring up a different name so it's not as confusing. And I'm going to go in them and I'm going to say, hey, I got something to do in Bank of America. And they're going to say, well, what do you want to do? And then it's the whole touchy-feely, try to open them up. Are you a buyer? Are you a seller? Well, I might not want them to know what I'm doing because maybe they have other clients that are doing different things. So I would say, I would say something like, make me a market in 1 million shares. And they would say, all right, I'll sell you 1 million shares at 33 and I'll buy 1 million shares at 30. So they just made a market for me. So that's where the term market maker comes from. So I think it's not as mysterious and evil like people think, Rodrigo, know what I'm saying?
Right. So, and we have another question here. How do you look at the QQQ, Mark?
Well, just the same way we look at everything. We just look for our important support and resistance levels. Now, why did we find support here? Well, because it was support back here, 2 years ago. And a lot of our students actually trade this because they trade the leveraged ones, the S triple Q and the T triple Q. But I would just say that looking at this, it looks range bound for now, but a potential strategy here could be, well, if it looks like Qs are going to break this resistance, there's a good chance they get up to here, the next level of resistance. So instead of buying Qs, if you have a little bit more risk tolerance, you can buy this, which is designed to move 3 times as much as Qs do, right? Yeah, so Qs are up 70 basis points. These guys are up 250. If you go back here to the Qs and you go to the other way and you think it's going to start to break down and break this support, then there is S triple Q, which is going to trade in the opposite direction with leverage, so 3 times. So if Qs breaks down and goes down 5%, this thing is going to be up 15%. So we have a lot of there's a lot of interest in the Qs in the class.
Right. So we've been here for quite some time, Mark. Appreciate your time and everything here. What are some closing remarks here you have for new traders and why they should join the school?
Well, there's a lot of myth out there. There's a lot of confusion out there, but I think that it's pretty simple. I mean, people should join the school because it's going to teach them how the markets really work. And from someone who actually spent 25 years there in the hedge fund industry, and you're going to learn how to develop your own strategies and your own styles. And it's going to take a little bit of work, but it's probably not as hard as you think. So now is a great time to learn about the markets because there's so much going on. So I would say that would be my closing remark. All right, Rodrigo, I'm going to give you the screen back. Is that all right?
Yeah, sounds good, man. Well, appreciate you, Mark. Thanks a lot for being here. I know you have, to get back to your stuff. So big shout out there, Mark Putrino, Chief Educator at the Benzinga Trading School.
All right, Rodrigo. Thanks, man. I'll talk to you tomorrow.
All right, man. Thanks. I'll see you in the school. All right, guys. So basically, that was Mark Putrino. He was here with us and we had a great session, but just keep in mind, Mark does this every day in the trading school, and there's a great community there. I think you should give it a shot and try it out. It's $7 for 7 days. And if you like it after the 7 days for the year, you can keep it. It's $14.97. And you do get a laptop as well. You get Benzinga Pro, which is our market research terminal where, this is what I'm showing right now, where you can see, you can do all your charting, scanners, all that sort of stuff. So on Twitter, if you want to join Mark Putrino, former hedge fund manager, traded with Steve Cohen, Mario Gabelli, multi-billionaires, 35 billion plus with a B. So if you want to trade with him in the trading school, I think you should give this a chance. On Twitter, you're going to see the thing posted there on the space. It has the link there. And on YouTube, you're going to see this. You're going to see it on the chat for sure. So thanks a lot for being here, guys. Big shout out to all you guys. Again, welcome to all the new members, and we'll see you guys next time.